Let's talk more about the IPO market with today's special guest, Avenue Capital Group co-founder, chairman, and CEO Marc Lasry, and Alex Rodriguez, who is the founder and CEO of ARod Corp. Do either one of you ever play in IPOs?
I don't.
Yeah, I couldn't imagine
hard.
you would. Alex, you haven't been lured in by any of these
not
things?
For me.
So what do you think? What's been crazy about this is kind of watching the market with so many of them trying to get to market now. Some people say that's an indication that they think the end is coming. What do you say about that, Mark?
Well, if you're a private company, you want to go public right now. Why? Because the market keeps reaching new highs, so there's a huge amount of demand for equities, right? So I understand why everybody wants to go public, and that makes sense. I think for somebody like us, really all we're going to do is just wait, and sooner or later, things are going to go the other way. Mm-hmm. So, we're going to wait about another year or 2 years for whether these companies, hopefully some of them have debt, and we can buy that debt at a discount. But look, I think for all these
companies, if you're buying that debt at a discount, it's because it's distressed debt, and you think that they're going to be in trouble before things really.
That's exactly it.
That's where.
Yeah. So you've got to wait.
Alex, my guess is if you're looking at any of this stuff, you're looking at it long before it comes to the IPO as an early investor.
Yeah, I mean, look, I love the idea of buying great companies that are over $1 billion, let's say in the fourth inning at first inning pricing. And we like to invest in things we understand, things that we bring in more than just our resources, but where our team and our expertise and perhaps some brand value, we can be great strategic partners to young founders.
What have you found along those lines? You mentioned a couple of companies earlier.
Yeah, I mean, for one, we like FitPlan. It's interesting, FitPlan and Sonder, both founded by a pair of Canadians, both very smart. If you think about where Airbnb is today at $30 billion with about $4 billion of revenue, you look at Sonder, and we looked at those numbers, and they're projected to be north of $4 billion in revenue, and we're buying it sub $1 billion. So we just think that it has the potential to be a $5 or $10 billion company. And if we miss, we still got a triple, and we're good with that.
You think that's a company that eventually gets bought up by one of the other players in the industry?
Absolutely, and I think one of them could be Airbnb, perhaps, could be a buyer. But again, there's so much disruption, and you just got to pay attention every day, because whatever worked 5 years ago probably doesn't work today and is not going to work in 5 years.
And Mark, in the meantime, you're just sitting back and waiting for tougher times to come along for some of these companies?
Yeah, I'm a big believer that there's a lot of knuckleheads out there, and that sooner or later, people make mistakes.
Is it hard to be patient when
there's
so much liquidity out there?
It is. I mean, that's actually why we're focused more on sort of Asia and Europe where there's issues. One of the things we're doing here in the U.S. is we buy tax liens. So I'll buy the tax lien of where you live, and it's impossible to lose money, but you can buy these because you're buying your tax is 1 or 2%. We'll buy it at par from the town or the city, and you get paid 9% until it gets paid off. So, but you're only going to make 8 to 10%. So, yeah, you've got to wait. You
mentioned retail as another area in the United States where you think it's really interesting. It probably is. There are great deals there, but there's also a lot of risk that some of these players are just not coming back. How do you sort through what you think survives and what doesn't?
Yeah, well, it's a great question, because what we've got to do is we're buying based not on the potential of that company turning around, but what the value of that real estate is.
That's it?
Yeah,
You're looking at this stuff as like just the land?
It's what's the liquidation value, and if everything works, then you're going to make a bunch of money. If it doesn't work, then you'll break even or make a little money. But it's very, very different. Where it was sort of 5 years ago, you'd say, oh, great, I'm buying this at a 6 multiple. Today you can buy it at a 4 multiple, and you have no idea if it's going to be around in 5 years. Mm-hmm. So what Alex is talking about, this whole disruption that's happening there, it's huge. So I think for us on the retail side, what you've got to do is look at the value of what the assets are, and then say, I'm happy to invest there. And if the company does well, that's how we're going to make money.
Have you, as a debt guy, a distressed debt guy, have you watched the global interest rate picture over the last 18 months and just go, what is happening? Is it confounding to you? Does it all make sense? Is it troubling to you? You're so laid back about everything. And then I was going to ask you, You can respond to that. But I was also going to ask you whether the U.S. is a distressed debt situation at this point at $22 trillion. And I don't think you say it is, because you always feel fine with it.
Yeah, no, the U.S. is fine. You can borrow more money. The problem, and Larry spoke about it a little bit earlier in your show, the fact that you've got negative interest rates in Europe. So really what that means is if you've got no issues, you can borrow money at zero. Right? If you've got issues, you can't borrow money. I mean, it sort of becomes this market of have and have-nots. In Europe, we're lending at 10 to 12%. Now, if somebody's borrowing when they've got no issues at zero, the only reason they're paying 10% is they've got a situation, and we're coming in, and we're going to have all the collateral that's there, but you're getting massively overpaid for that.
But you're doing the same thing that the banks here are doing, you're saying, where you're not going to loan to them either unless you get the collateral.
Yes, that's exactly it. No.
So would it be a good short on office space in London and Asia?
Yeah, because the minute rates start moving up, real estate has to go down because your cost of capital is going up. But I just don't know when that's going to happen. You never want to fight governments.
Or the Fed.
Or the Fed. Right? You'll lose. I mean, you may ultimately win 10 years from now, but the cost of that is just too high. So for us, really all we're doing is we're part of that shadow banking industry where we'll lend money. You know, 5 years ago, everything we did was on the public markets. Today, 75, 80% is all private. So that's how it's changed. I'll give you a great example. In Ireland today, you used to be able to borrow from the banks at sort of 5, 6% if you had a small business or you had real estate. The ECB comes in and says, you can't do that anymore to the banks because it's not a rated loan. So we end up buying that business, and now we loan in Ireland, and we make those same loans at 10 to 12%. Why? Because we're the only ones in that market. And it's ridiculous, because who got hurt? People got hurt.